everyone. And we're live. Good morning. And
oh yeah, this is
right. Good morning, while Harry has a moment. Welcome to 10 minutes at 10 for everyone. Today we're going to talk about your balance sheet. So what do we need to know about our balance sheet? The balance sheet is a sum of what you own versus what you owe. So it's your assets less your liabilities equals your equity. So you can compare it to measure your movements over time of how your assets have grown or how your liabilities have shrunken, hopefully, and how the balance that your business owns, the net value of your balance sheet is hopefully improving. So, Harry, what do we need to look out for?
So, first thing in the balance sheet, which I'd say is vital for anyone who is a limited company and which you have directors. Keep an eye on your director's loan accounts. So there'll be one per director, and it's really, really important to monitor this. We want to make sure that you're not overdrawn at any time.
I personally think that's the most important account in the balance sheet for a limited company.
Yeah, I would definitely agree. So what exactly do we mean by overdrawn? We mean basically you have a director's loan account and you haven't taken more than the company could issue in the way of dividends, by which I mean you have to have enough profit to cover your director's loan account. Other than this, there is also many other things in your balance sheet to keep an eye out for. So, for example, when you're reviewing your balance sheet, I personally like to review it not just on a year-by-year basis, but also on a month-by-month basis, because you can see trends. So, first things first, do you have any assets which are representing a negative value in your balance sheet? Likewise, same concept for a negative liability. Why are these odd? Because basically what you're saying is you don't have an asset, you have a liability.
Yeah.
Or you don't have a liability, you have an asset. So straight away it's odd. And what that suggests is perhaps a miscoding, or in the case of a liability, you're missing interest charges if you're paying down a loan. Other things to look out for are items such as assets not depreciating. We do see that. Sometimes you might have them capitalized, but they're not actually depreciating on a month-by-month basis. If they're not, it doesn't give you the idea for what your profit actually is on a month-by-month basis. Suspense accounts. Common one here is they shouldn't be having any balance in a suspense account. Or if it is, it should only be temporary. So what should happen is a suspense account should net off to zero. It's basically a nonsense account. It's deliberately there to say, this is an item to review. We need to review it.
I don't know where to put it. So you put it in a suspense account so that you can review it later. So ideally they clear, next month, same month. They shouldn't sit there for months and months on end, which is a common error we see in quite a few accounts when we take them over and start looking at them.
Yeah, it's basically, like you say, I have no idea what goes here.
I'm just going to bung it in the suspense account. And what you often find is that those there are costs or there is income posted into the suspense account that could be pushed into the P&L, or it should be pushed into the P&L. So we were talking about a queries account earlier on in the week, or perhaps last week, I think it might have been, and I would rather see queries put in a queries account in the P&L so that you know that your net profit or is the worst case scenario, than have it stuck in a suspense account in the balance sheet, which then potentially overinflates your P&L and makes it look like you're making more profit than you really are, in which case you're potentially making the wrong decisions about the state of your business and how to make it go forward.
Yeah. Other items such as loans we need to keep an eye out for. So basically, if you have loans, you could have multiple. Is the balance reducing in your balance sheet on a month-by-month basis? This is why I say it's really useful to look at it monthly. If it's not reducing at all, where's the payment? Have you made a payment? Has it bounced? Is it coded somewhere else? Is it reducing too quickly? Have you duplicated a transaction? Are you posting all the interest as a capital payment? Remember, interest charges are a P&L cost, and capital repayments are a repayment of a liability in your balance sheet. So
your balance sheet should be reducing your liabilities, but not too fast, because the other the reverse error in that scenario is that the interest and the capital is repaying the loan. So the loan balance depreciates or reduces way faster than it really ought to. And again, it looks like you're making more profit than you should in your P&L. So you're overinflating your profits and potentially making the wrong decisions on how to manage your business again.
Stands out really clearly on like hire purchase and loan agreements where you've got fixed repayment, because it should be reducing at the same rate each month.
Yeah.
So it really stands out. But likewise, other liabilities should also be reducing as well, as long as, of course, you're making payments on them. So PAYE, VAT, etc. We'd expect to see this reducing. If you're aware that you're not making a payment for one reason or another, then that's fine. But just as long as the balance is reducing if you know you've made a payment.
Yeah. So where is the profit in your balance sheet? Now, that's an odd question to ask.
Especially when everyone looks at P&L. But
well, you look at your P&L for your profit or your loss. But if you've accidentally coded stuff to your balance sheet that belongs in your P&L, you could potentially be overstating your profits and potentially taking out too much money by way of a director's loan account, thinking that you've got all this money to take out the business, or you're understating your profits in the P&L because you've got stuff that's sitting in the balance sheet that shouldn't be. So let's have a look at where the profit could be, but it's in your balance sheet. So one example is tax reducing expenses are posted to the balance sheet in error. So you're potentially overpaying your corporation tax because you're overstating your profits because you've got costs sitting in your balance sheet. So that could be things like small assets. Quite often certainly in Xero and sometimes in QuickBooks, the assets accounts might say, office expenses or office equipment, and you're posting stationery and equipment into the office expenses account thinking that it's going into the right place, but actually it's put it in the balance sheet, not the P&L. So your accountant should sort this out at year end, but in the meantime, your profits are overstated because you're not tracking all of your costs. Conversely, if you've got income or customers that you've been working on and you are doing work for your customers, but you've not invoiced it. So say you're working on a project that might be 2 or 3 months of effort. If you're not accruing that revenue into your profit and loss, but you're still working on that so that you can't generate income from other areas, then that income is not showing up in your P&L. So you're understating your profits. So what you would do in that case is accrue the income into your P&L and show that income accrual in your balance sheet. So if that's not there in your balance sheet, you're missing potential profit, which again means that you can't draw as much out of the business as you might otherwise have done so. It might be that you have costs in your P&L that you haven't been billed for, so you're understating you're perhaps overstating your profit because you're understating costs. So again, you're paying more tax. So in that instance, we can accrue the cost in your P&L and show that accrual in your balance sheet, which then makes sure that you're paying tax on the right profit. So let's not pay more tax than we ought to. It could be that we've had costs in our P&L that actually relate to spends that belong to the following year, like rates and insurance, for example. If you have a big rates or insurance bill at the end of your financial year and you're taking next year's cost in this year's accounts, then you're understating your profit and you're not showing the right tax liabilities. You're perhaps paying too little tax and taking too little money out of the business, thinking that you're making less profit than you have done. So if we prepay those and put them in the balance sheet, then your accounts are correct in your P&L. You can draw that extra cash out of your business because you've made more profit and you can pay your tax bills.
So in the balance sheet, to summarise, account codes we need to look for prepayments, accruals,
and
accrued sales
income,
and deferred income as well.
Yeah.
So all 4 of those, if you're expecting any items in them and they're 0 or they're not showing, then that means we've probably missed one.
Yes. Now, in certain circumstances, there are costs in your P&L that potentially could be capitalised or deferred. So these might be work in progress, for example, if you've got staff or a team of people, consultants that are working on a project that you haven't billed yet, that is technically work in progress and could be capitalised or put into your balance sheet. It's not technically capitalised, but it's put into your balance sheet and written back later. You could have staff, consultants, and costs relating to R&D or web development. And in certain circumstances, if you're reporting under the right accounting standards, those costs can be capitalised as an intangible asset in your balance sheet and taken out of your P&L, which means that your P&L looks a lot healthier, and therefore you have more distributable income. So we're moving that profit into the balance sheet so that you can then take it out. Those are certain circumstances, though. It's the difference between FRS 105 and 102 accounting, which we'll not go in today. So if you're in doubt, review with your accountant, quarterly at the least, annually if you absolutely have to. And the whole point of reviewing these with your accountant on a quarterly basis is so that if there is something that's not quite right, if your balance sheet is showing negative liabilities rather than positive assets, you really want to have time to do something about that before your year end, and a conversation with your accountant can deal with that and help push you forward. So thank you for joining us in our 10 minutes at 10, where we looked at the balance sheet today, particularly looking at where the profit might be in your balance sheet. If you're in the BBB club, you can log in and take a deeper dive into today's lesson. If you're not, click on the link below, which I will add today, and you can join. So thank you very much, and we'll see you tomorrow. Bye. And we're ending the video.
I had a moment of madness at